Big blow to NRIs who also earn money from other countries like India. Starting April 6, 2025, the UK government will change how it taxes your income. Right now, many residents only pay tax on foreign income if they bring that money back to UK. This was called remittance bias. But from April 2025, this rule will end. If you live in the UK, you will now have to pay tax on all the foreign income that you generate worldwide, even if you don't bring that money back to the UK. This includes dividends from Indian companies, interest from NRE or NRO accounts, profits from selling any Indian properties or shares, rent income from Indian houses, and business or freelance income generated in India. Some people may get some relief for the first few years, but in general, all worldwide income will now be taxed. For NRIs, this could mean that you're going to pay double taxes in India as well as in UK. But thanks to Indian UK double taxation agreement, you can claim credits for the tax that you've already paid in India, avoiding paying the same tax twice. It's important to stay informed, keep records, and take professional advice to plan ahead. Alright, so for people who have been using the old system where you only paid UK tax when you bought your foreign income into UK, there are some helpful rules during the changeover. First, there's something called as a TRF. That lets you bring your foreign income or gains that you've earned before April 25 into UK, but pay tax at a special lower rate for the first 3 years, 12% in the first 2 years and 15% in the third year. This is way lower than the usual tax rates. The idea is to make it easier and cheaper to bring that money into the UK now. Second, there's a thing called capital gain base cost rebasing. If you've claimed the remittance basis before and you were a UK resident back in April 2017, you might be allowed to reset the value of your foreign assets to what they were worth then. Why is this helpful? Because when you try to sell these assets after April 25, you will pay tax only on the gains since 2017, not the total gains since you originally brought them. This can lower your tax bill, but remember, not everyone will qualify for this. It depends on your residency status back in 2017 and whether you claimed the remittance before. So these two changes are basically to help you transition smoothly into the new tax rule before facing a huge tax hit all at once. Okay, so here's something helpful if you're planning to move to the UK and haven't been a UK resident for the last 10 years. The UK is introducing something called as 4-year foreign income and gains regime, or the FIG. What does this mean? Basically, if you become a UK tax resident after spending 10 years straight living outside the UK, you will get a 4-year tax break on the foreign income and capital gains. That's right, for your first 4 years, you will not have to pay any UK tax on money you earn outside the UK. Even better, you can bring that money into UK, transfer it to your UK bank account, spend it, do whatever you want, and still not get taxed. That's called full tax-free remittance. Now, to get this benefit, you will need to claim it every single year. It is not automatic. And remember, this is temporary. After those 4 years are up, you will be taxed just like everyone else in the UK on your entire global income and gains. So if you're planning a move, this gives you a clean 4-year window to structure your finances smartly. Let's break down two big upcoming changes. One is the trust taxation and the other one is the inheritance tax. First, offshore trust. Right now, non-DOMs can set up an offshore trust and avoid UK tax on income and gains kept inside. But from April 2025, that's ending. If you qualify for a 4-year FIG window, your trust can still delay the UK tax. However, after 4 years, any income or gains, even if you're not withdrawing that, will be taxed in the UK. Plus, anti-avoidance rule will block any workarounds. Now the inheritance tax. Currently, it's based on whether you're a UK domiciled. But from April 2025, it will be based on residency instead. If you've lived in the UK for 10 or 12 years at least, your global assets, not just the UK ones, will fall under the UK inheritance tax. Even if you leave the UK, you might still be liable for up to 10 years. So this is a major shift, especially for NRIs with overseas wealth. Estate planning just got way more important. Let's talk about how to avoid getting taxed twice, once in India and again in the UK. That's where the India UK Double Taxation Avoidance Agreement comes in place, or the DTAA. It's a treaty that lets you claim credit in the UK for taxes that you've already paid in India. So, if you're a UK tax resident earning Indian income like rent, dividend, interest, or capital gains, the UK won't tax you again fully. You will get credits for what you've already paid in India. But to use this benefit, you will need to prove that you're a UK resident and submit the right forms, including a tax residency certificate. From April 2025, the UK will start taxing all global income, including anything earned in India, even if you don't bring it back to the UK. So, income from Indian stocks, mutual funds, or property will all be taxed there too. The DTAA becomes even more important now to reduce your burden. For example, Indian interest tax at 30% can now be capped at 15% under the DTAA. There are also UK reliefs that are coming in place, like a 12% flat tax on all foreign income if you bring it between 2025 and 2027, and a one-time chance to reset the cost for foreign assets to April 2025 to the lowest capital gains tax ever.